What's going on, fanatics? Today we're going to be learning about investing for beginners, or aka stonks. Again, this presentation is for informational purposes only and is not intended to be professional advice. Okay, so to start off, we want to learn about the S&P 500, and this is called an index. An index tracks the performance of a group of stocks, and in this case, the S&P 500 tracks 500 of the top US stocks. This replicates the US economy. And so, given that the US economy is the largest economy in the world, everyone wants to compete against the US economy, and therefore we can compare our performance in investing to the S&P 500. There's also the S&P composite, S&P mid cap, and S&P small cap. And mid cap and small cap just stand for basically medium-sized companies and small-sized companies, while the composite encompasses all of them. Over the course of 15 years, 92% of finance professionals couldn't actually beat the S&P 500. For the 8% that actually managed to beat the market, they aren't the same 8% every single year. And so this kind of brings the point of not really overshooting for anything that is significantly greater than the S&P 500's return, which is on average 9.8% every single year. So if you're doing better than 10% every single year, you're already killing it. Secondly, I want to highlight the fourth richest person in the world and the most famous investor of all time, Warren Buffett. So as you can see on the graph on the right, if you put $1,000 into Warren Buffett in 1960 and left it until 2020, you would be worth $27 million. But we have to look deeper into the numbers because this is a result of compounding interest. So you can't just take $27 million and divide that by 1,000 and say he made 27,000%. You have to look at it year over year, compounding, and use reverse calculation with the compounding interest formula. And so it roughly comes out to 20%. There's a huge debate between whether you want to buy a home or keep your money in investments. So here we're taking a look at investment returns in real estate, in specifically Vancouver and Toronto versus the S&P 500. So as we can see in these hot markets, Vancouver and Toronto have outpaced the growth of the S&P 500 from 2005 to 2019. So as you can see, this is the reason why people invested in Vancouver and Toronto real estate as opposed to S&P 500. So the next thing we need to talk about is the time value of money. If you look at this graph from 2019 to 2029, there is something called inflation. And so inflation essentially means the economy of the world grows at 2% every single year. When you want to talk about how much value your money really has, we want to measure it against inflation. And the reason for this is because governments offer a 2% bond, which is deemed the most valuable, which is deemed the most safest investment that you could put anywhere, because governments should theoretically not go bankrupt or default. And therefore, if you took all of your money and put it in government bonds, it would give you a 2% increase every single year. And so instead of stuffing your money under the couch, you should theoretically put them into government bonds and increase it at a rate of 2% to keep its real dollar value. So to further illustrate this point, we can take a look at box office records from 1997 to 2019. Based off of this, Avatar is actually the highest growing movie of all time. Titanic is actually greater than Avengers. Next, I want to be talking about the actual process of signing up to buy stocks. One, you go to the bank, either at TD, BMO, RBC, whichever your bank is. You go to the branch, you tell them, hey, I want to open up a direct investing account, either a cash account, a TFSA, or RRSP, and I'll explain those in a second. Once you sign all their forms, you wait a couple days for your account to be created, and once it's created, then you can transfer money from your checking account into your stock account, and then you can begin to buy stocks. Now, the second option is to sign up with an online brokerage, which usually takes the form of a website. So you go to their website, create an account either at Wealthsimple, Interactive Brokers, or something similar. You fill out their application form for either a cash account, TFSA, or RSP, and then you transfer those money from your bank account into those accounts and begin buying. So now we want to talk about the different types of bank accounts. So starting from the left, we have a checking account, which is your standard bank account where you deposit money. Second, we have a high interest savings account, which is essentially the same thing as a checking account, except it gives you a 0.5 to 1% interest rate. Now, we have non-taxable accounts, which are the tax-free savings account, or TFSA, and RRSP, as well as the RESP. So RRSP stands for Registered Retirement Savings Plan, and Registered Education Savings Plan, RESP. The TFSA has a contribution limit of $6,000, and what this means is every year you can only put $6,000 of your money into the TFSA account, and you have to be 18 in order to open a TFSA. So there's actually a TFSA chart that goes back all the way to 2009 that shows you the contribution limit every single year since 2009. You calculate the year that you were 18 and you add up all of the contribution limits of that year to find your total contribution. For example, if this year you're 19 instead of 18, you would take the 6,000 from this year as well as the 6,000 from last year, and you would have 12,000 in contribution room. And if you put 12,000 into your TFSA account and you buy stocks, whatever money you make on that stock is tax-free. Now, the RSP is a little bit different, and this comes from deducting income from your current wages. So if you work, let's say, as an accountant, and you make $70,000 a year, you take 18% of $70,000, and that's your contribution limit for the year. Using that same concept, you can take $12,600 from your pre-tax income into your RRSP, and whatever money that you use inside of the RSP and make investment income on it is tax-free. However, the difference here is that when you withdraw money from the RSP, your contribution doesn't go up, but you're also taxed on withdrawing the RSP, and the money that you withdraw counts as your income. So if you're making $0 for the year from an income perspective, but you have 12,000 inside of your RSP, if you withdraw that 12,000, you now made 12,000 for the year and have to report that for taxes. RESP is a little bit different. You have a lifetime limit of 50,000 per child. So if you have two childs, you can put $100,000, and you also get government grants which give you free money based off of the fact that you have this account. Now, you have to start this account before your child is 15, otherwise you are ineligible. I want to introduce to you the fact that there are other things to buy other than stocks. There are GICs, which are pretty much the closest thing to a government bond, which are really safe but very low returns. And then we have gold, we have real estate, bonds, private equity, mutual funds, peer-to-peer lending, and cryptocurrency. Liquid means it's easy to sell and you can get your cash right away, and illiquid means your money is stuck there and you can't take it out. And that's about it. I'm not going to go too much into what each one of these assets are. I can talk about them specifically in another video. I just want to bring to your attention that there are other things that you can buy other than stocks to help you diversify your risk. So this is just an example of how you can diversify your portfolio. So you have money in your TFSA and you put 22% of it towards real estate, 29% in stocks, 37% in gold, and 11% in money. And this just helps you, again, balance your risk. That's pretty much it. Thanks for watching. I hope you enjoyed that and learned something today. If you liked my content, share it with a person that you know, and also submit more topic requests. Thank you.